Let me show you two numbers. The first one is $119. The second one is $24,400. Same person. Same account. Same monthly contribution, dollar for dollar, never missed, never increased. The only difference between those two numbers is time, 29 years of it. And once you understand exactly why that gap exists, you are going to look at your own account balance completely differently, because there is a specific number sitting inside your account right now. Not a percentage. Not a strategy. An actual dollar figure, where your money quietly stops behaving like savings and starts behaving like a second income. Almost nobody has ever been shown where that number sits. By the time we finish, you will know exactly where it sits in yours. Before we go anywhere near that number, here is exactly what we are modeling, stated plainly, because the honesty of the model is the entire point of this video. We are following one hypothetical saver, we will call her Kate, contributing the same amount every single month into a diversified stock index account for 30 straight years. We are assuming a 7% real return, meaning 7% after inflation has already been subtracted out, based on the long-run historical average of the S&P 500 with dividends reinvested. That figure is not cherry-picked for drama. It sits at the well-supported end of a range confirmed by independent return data compiled by researchers at NYU Stern, and cross-checked against decades of institutional return analysis. But a long-run average is not a promise. Markets do not move in a straight line, some years land sharply negative, and nothing in this video is personalized investment advice for your specific situation. What it is real math, done honestly, in front of you, so you can go run the same math on your own numbers tonight. Here is Kate's first year. She contributes her monthly amount faithfully, 12 times, without exception. At the end of that first year, the market has done its work on top of what she put in, and the actual investment gain, the money the market handed her that she did not personally contribute, comes out to $119. $119, for an entire year of discipline. If you have ever looked at an account like that after 12 months and thought, this is not working, I want you to sit with that feeling for a second, because it is the single most common reason people quit right before the part that actually matters begins. Picture her account on the left side of the screen in that first year, a line so flat it barely lifts off the bottom of the chart. Now picture that exact same line, 30 years later, on the right side, rising almost straight up off the top of the frame. Same account. Same person. Same habit, repeated without drama, month after month. That gap between the left side and the right side is not luck, and it is not a market miracle either. It is a mechanism, sitting underneath the surface the entire time, and we are about to open the container and look inside. Here is the part almost no one explains clearly. What drives your account's growth is not primarily how much you contribute this month. It is how large your balance already is. Contribution size matters most early. Balance size matters most later. In year 1, Kate's balance is small, so 7% of a small number is a small gain, that $119 we just looked at. But by year 20, her balance is no longer small, and 7% of a large number is a large number. The mechanism itself never changes. The size of what it is acting on changes completely. Think of her account as a container that is slowly filling. In the early years, if you could isolate that box and look inside it, almost everything sitting in there is money Kate physically deposited. Growth is happening underneath the surface too, but it is small enough to stay invisible next to her contributions, like a second, quieter layer stacked beneath the obvious one. Fast forward, and if you zoom into that same container again, the composition has flipped entirely. Most of what is sitting inside it is no longer her deposits. It is growth sitting on top of growth on top of growth. The box looks the same from the outside. What is locked inside it has completely changed. And there is a specific point where that flip happens. Not a vague feeling, not a milestone somebody else picked for her out of a textbook. An actual balance, sitting in her real account, where the market's contribution for the year finally catches up to, and then passes, her own contribution for the year. We are going to name exactly where that point sits in a moment. But first, I want you to see where most real accounts, in the real United States, actually sit today, because the gap between where people assume they are and where the data says they actually are is bigger than almost anyone expects. To make the flip concrete, we are going to use 3 rungs, stacked on top of each other like 3 ascending containers, with Kate's balance climbing through them one at a time over the 30 years. I want to be upfront that these 3 names are our own working labels for this video, not official financial terminology you will find printed in a textbook or a prospectus. We call them the starter floor, the inflection band, and the catch-fire threshold. The starter floor is the stage almost everyone begins in, and the stage most people are still sitting in right now without realizing it, where your own monthly contribution is doing nearly all of the visible work, and the market's contribution is small enough to round to zero if you are not looking closely. This is exactly where Kate sat in year 1, with that $119 gain sitting underneath a much larger pile of her own deposits. The inflection band is the stage where the market's yearly contribution and Kate's own yearly contribution are finally running roughly neck and neck, where, for the first time, you could put the 2 bars side by side on a chart and neither one embarrasses the other. This is the stage that almost no compounding content ever shows you, because it is the least dramatic looking part of the entire chart, and it is also the exact stage where most people are tempted to quit, right before the geometry starts working in their favor. The catch-fire threshold is the stage where the relationship flips completely, where the market is now contributing more to the account in a single year than Kate is, without her changing a single thing about her own behavior. Nothing about her discipline improved. Nothing about her income changed. The mechanism itself simply had enough balance to work with, and once it does, it stops needing much help. So where do real accounts sit against those 3 rungs, right now? Not hypothetically, but according to actual survey data. The Federal Reserve runs a detailed household survey every 3 years called the Survey of Consumer Finances, and the 2022 edition gives us the median retirement account balance in the United States, broken out by age bracket. Read these numbers carefully. Under 35, the median balance sits at $18,880. Ages 35 to 44, $45,000. Ages 45 to 54, $115,000. Ages 55 to 64, $185,000. Look at that last figure again. The median American household in its peak earning years, ages 55 through 64, sits closer to the starter floor and the inflection band than to the catch-fire threshold. That is not a personal failure, and it is not a story about a generation that did not try. It is what the long, flat, discouraging first decade does to people. It convinces them the math is not working, at the exact moment the math was about to start working hardest, and a meaningful number of them stop contributing, or pull money out, right before the curve was going to reward them for staying. If this is the first time anyone has shown you where that Fed data actually places the average household against a chart like Kate's, that alone is worth staying for, because most people watching this have never once seen their own account plotted against a real, sourced benchmark like this one. That is also worth subscribing for, because we are going to keep running real numbers like this one against real charts, video after video, instead of vague encouragement to just start early. Now back to Kate, moving into her second decade, and this is where something shifts that will not show up cleanly if you only glance at a simple rising line. It shows up the moment you compare her yearly contribution against her yearly market gain, side by side, year by year, like 2 bars racing each other up the screen. In year 10, her market gain for that single year finally starts closing the gap on what she personally contributed that same year. By roughly year 15, the market's bar has passed her contribution bar, and it does not look back. Her account is no longer waiting on her monthly deposit to grow. The deposit has become the smaller of the 2 forces acting on her balance, and every year after this one, that gap widens further. This is also where the flat feeling from the first decade quietly reverses into something closer to momentum. The same 7%, doing the exact same thing it was always doing, now has a genuinely large number to act on instead of a small one, and a genuinely large number moving at 7% produces a very different sized outcome than a small number moving at the same rate. Nothing about the rate changed. Everything about the base it is acting on did. Before we get to year 30, I want to slow all the way down and give you the honest counter to everything you have just heard, because a model is only useful if it tells you exactly where it can break, and this video is not interested in only telling you the flattering first, fees. If Kate's account is quietly paying 1% a year in fees, not a dramatic number, the kind that hides inside a fund's expense ratio without anyone ever pointing it out to her, that single percentage point, compounding against her for 30 straight years, costs her account roughly $65,000 by the end. Not $6,500. $65,000, gone, for doing nothing except never once checking a number that was sitting on a fund summary page the entire time. Second, the return assumption itself. We modeled 7% real. If the actual long-run return over Kate's specific 30 years comes in closer to 5% instead, still a perfectly reasonable, historically grounded outcome, just a less generous one, her ending balance lands around $251,000 lower than the 7% version. Same discipline. Same contributions, dollar for dollar. A different multi-decade market environment, and $250,000 difference sitting at the finish line. Third, and this is the piece almost no compounding video ever mentions, sequence matters, not just the average. Two savers can post the exact same average return over the same 30 years and end up in very different places, depending on when the good years and the bad years actually land. A saver who gets hit with the worst years right before they need the money is in a fundamentally different position than one who gets hit with the worst years back in year 3, when the balance is still small and has decades left to recover. Anyone who lived through the 1970s, or 2008, or the dot-com collapse, will tell you the same thing without needing a single chart: the market does not care what year would be convenient for the bad stretch to arrive. The 7% figure is real, and it is historically grounded, but it is a long-run average sitting on top of a path that genuinely zigzags, some years sharply up, some years sharply down, even though the 30-year destination holds, fourth, one small technical distinction that is worth knowing, because it gets misquoted constantly in this exact kind of content. When you hear the stock market's average return quoted somewhere around 10%, that is usually the compound annual growth rate, the single steady rate that would carry you from the starting balance to the ending balance if growth were perfectly smooth. That is not the same thing as adding up each year's return and dividing by the number of years. If your account gains 50% one year and then loses 33% the next, you have not averaged something positive, you are back almost exactly where you started. That gap between the two ways of averaging a return is exactly why the number quoted in headlines tends to run higher than the number your actual account experiences. And fifth, starting later changes more than people expect, but it does not erase the mechanism. Someone starting this same habit at 40 instead of at Kate's starting age will spend proportionally more of their working years inside the starter floor and the inflection band, and less time inside the catch-fire threshold, simply because there are fewer years left for the balance to grow large. That does not mean the math stops working. It means the flat, discouraging early stretch we described at the start of this video matters even more for a later starter, because there is less runway to make up for quitting early. Now, back to where we started. Kate's year 1 gain, $119. Her year 30 gain, in that single year alone, $24,400. That is not 30 times the growth. It is not 50 times the growth. It is roughly 200 times the growth, produced by the exact same monthly habit, without a single additional dollar of contribution ever being added. Picture those two bars sitting on screen together, side by side, one bar so short it is barely visible, and one bar rising nearly 200 times its height. That is not a chart exaggerating for effect. That is what the underlying math actually produces when you let it run uninterrupted for 3 full decades. So here is the full scoreboard, one more time, straight through, no rounding in our favor. A 7% real return, modeled honestly, sourced from independent long-run return data, not selected for drama. A first-year gain of $119 that genuinely feels like nothing. A starter floor, an inflection band, and a catch-fire threshold, 3 stages that, according to the Federal Reserve's own household survey data, most real American accounts are still climbing through well into their 50s and 60s. A possible $65,000 cost hiding inside an unchecked 1% fee. A possible $251,000 swing sitting inside a lower return decade that has happened before and will happen again. An honest acknowledgement that the path zigzags, sometimes sharply, even when the 30-year destination holds. And a year 30 gain, in a single year, of $24,400, roughly 200 times where the exact same account started. If you take one thing from all of this and actually do it tonight, do this. Pull up your real retirement account. Find your total contributions over the last 12 months. Find your total balance exactly 1 year ago. Find your total balance today. Subtract the difference, subtract out your own contributions, and whatever number is left over is your real, personal, year 1 style gain, or if you have been doing this for a while already, it is your real, personal proof that your own flip has already begun. That number, sitting inside your own account, is worth more than every number we have covered in this entire video, because unlike Kate's numbers, it is actually yours. But here is exactly what that number, by itself, cannot tell you. It cannot tell you what changes if you are starting this today at 40 instead of at Kate's starting point. It cannot tell you what happens if you double your monthly contribution instead of holding it flat for 30 years. And it cannot tell you whether running this exact same math inside a Roth account instead of a standard taxable one changes your ending number more than anything else we covered today. Those are 3 completely different outcomes, produced by 3 completely ordinary decisions, and almost nobody ever puts them side by side to compare. That is exactly where we are headed next.